Hello, my name is Martin Clayton and I'm a wealth manager at Swan Financial Consultancy. Swan Financial Consultancy specialises in inheritance tax and estate planning, but also pension planning and investment planning, specialist insurance, long-term care and mortgages. But alongside that, we also specialise in protection, and it's that I want to talk to you about today. It's a common misconception that financial advice is all around where to put your money, how to make the most money, and how to benefit from it on the other end. But what's the point of all that if you don't actually make it? What if you have debts and liabilities that aren't looked after in your working life? The Financial Conduct Authority for many years have put an order on how you should do financial advice, and I call it PIPSI: protection, income, pensions, savings and investments. Protection is first. Today I want to talk about the different types of protection available for you and your family. There are many types out there, and it may not be that you need all of them, but it's important you know what each one does so that you can protect yourself efficiently and fully. There are 4 types of protection I'd like to talk about today. Term assurance, simply life cover, critical illness, income protection, and family income benefit. There is a 5th as well, a whole of life cover. Now, I'm not going to go into too much detail about that today. However, it's a really important piece of protection planning, normally associated with inheritance tax planning. We have specialists, as I've mentioned, that can help in this. If you haven't spoken about it already and think it might be relevant, please speak to us separately about inheritance tax advice. So, looking at the first one, term assurance. Last year, the ABI supplied us with some really interesting statistics. There are 26.5 million households in the UK. Now, 75% of them have car insurance, and 62% of them have buildings insurance alongside their mortgage. Fine, you might need those to get the mortgage itself or to drive the car. Only 10% had mortgage protection. And it gets even worse, only 2% had term life assurance and 0.7% had income protection. So, the basics of term assurance, and then we'll look at some examples. Term assurance is more commonly known as life cover. It's a very simple product in the grand scheme of things. A tax-free lump sum that pays out if you die. There are some things you have to do to set one up. You have to set the policy length. You have to set the amount of cover, and then you have to choose how the premiums are done, whether it's level, increasing or decreasing. And those are the bits that we can look in at a bit more detail. Let's take, for example, why you're taking it in the first place. Term assurance should be used to cover a debt or liability that would cause issue if something happened to you. So let's take a mortgage, for example. If something happened to you or your spouse, would you want the comfort of knowing that the mortgage payments are sorted even if you've gone and your income is no longer there? That's a prime example of what term assurance is for. And in that example there, you'd look at how you set that up. It would be the length of the mortgage. So let's say, for example, your mortgage was 25 years. We'll set up the term assurance in the same period. You'd set the amount of cover to be the mortgage value. And then you would set the premiums to be guaranteed so that they never fluctuate and decrease alongside the mortgage. That way, the mortgage value is always covered. Your cover will go down in line with the mortgage. It's a very flexible product, and that's why you can have your payouts increasing, decreasing, set level. It can be used to cover absolutely anything that you have a need to be covered should you be not here to pay it. And that's the key question with term assurance. Who is the policy meant for? Is it meant for you? Is it meant for your spouse if you're not here? Is it meant for your children? Is it meant to cover your mortgage? Is it meant to cover another asset? Have a think about that, because these policies can be set up for multiple reasons and multiple people. So, as an example with the mortgage one, You may choose to have that as a joint life policy. It will pay out when one of you dies to the other one. But it might be that you want to leave something for the children as well. A single policy in your name would pay out to them. If it's just you you're protecting, it may be that putting it into trust to somebody you love or to somebody you want to make sure inherits the money is the right way to do it. I'll give you an anecdote on that one. Say that you've taken out a policy against your mortgage. You want to leave that house to a loved one, a niece, a nephew, whoever it may be, so that there is something that remains as an asset in your family line. By putting a single policy into trust, that can pay directly out to the person who needs it, meaning that they can pay off the mortgage when you're not here and keep the property. I'm using mortgages a lot as an example there, but it may be that you've got something else that needs covering. Speak to us directly. We can tailor something. The next one I want to talk about is critical illness. Now, critical illness and life cover go hand in hand with each other a lot of the time, and there's a very simple reason for that. It may be, using that mortgage example again, that you don't just want to cover yourself for if you die, you want to cover yourself for if you're seriously ill, i.e. if your circumstances and/or income are going to change. A lot of critical illness policies normally have life cover alongside it. It's normally a free added benefit to a critical illness policy. Naturally, critical illness is going to have a far higher claim rate, and it does mean that it's normally more expensive than life cover. But the chances of you needing it are much higher. Each provider has a raft of different critical illnesses that they cover, and I can't go through them in this webinar alone. So if there's something specific that you need covered, that's another reason to check the providers out there and not just go for the cheapest quote. Most of them will cover the basics, heart attacks, lung diseases, but when you get into things such as cancers, an all too common illness now, they're very particular, and it may be that you need to check your provider does exactly what you want it to do. So to clarify, specified illnesses vary. So let's take an example with that critical illness. Imagine that you're the breadwinner and your wife or partner is a stay-at-home parent. You may think there that the biggest thing to worry about is if you're ill, if your income stops. But what if something happened to them? It may be that suddenly childcare costs will be massively increased. It might be that you have to stop doing your work. It's really important to think about the potential pitfalls of one of you becoming sick in the family rather than just as an individual. And in that instance, paying off the mortgage may be an absolute lifesaver to just make sure the monthly commitments are met in a reduction in income. Whilst we're talking about family as well, it's really important to look at the added benefits that critical illness does these days. You can include your whole family on it through children's critical illness as well. Now, it covers normally about 25% of the policy or a specific lump sum, but it does absolutely enable you to have that peace of mind that if something happens to the children that involves more childcare, you're covered there as well. And that one may be just a case of providing out a lump sum to replace lost income. So, moving away from lump sum benefits, I now want to talk about income. Most employed individuals will have some element of sick pay. Some companies offer 3 months on full pay and then put you on statutory sick pay. Self-employed individuals do not qualify for any, but that does raise the question, do you actually know how much statutory sick pay is? I'll put you out of your misery. As of the 2020/21 tax year, the statutory sick pay is £95.85 a week. Now, I don't know about you, but for most people, that probably will cover their mortgage and nothing else. Maybe not even cover that. Could you live off that, is the key question. This is particularly relevant for self-employed individuals, although there is a great quirk that makes it very affordable for employed individuals as well. Income protection is effectively creating your own sick pay policy. It normally pays out a tax-free payment after a set period in the region of 55 to 60% of your normal annual salary. Now, there's a very good reason it's that number, and it's two things. Firstly, it's tax-free. It means that actually once you take off the fact that you won't be taxed 20%, 40%, 45%, whatever the policy amount's for, you actually back up to a nearer number. The second one is there needs to be some incentive to go back to work. Premiums do vary hugely on income protection. Obviously, as a standard point, it depends how much you want to be covered for, and it is worth noting that you cannot cover yourself for an unlimited amount. When you claim, you'll have to show evidence that you're claiming for what you normally would have earned. Now that's normally done through, if you're employed, your PAYE reports. If it's not employed, then on your self-employed basis, it would be your tax returns at the end of the year. The way to bring the cost down on income protection is quite simply to work out how long you could afford to live before you needed help elsewhere. We always say to clients that you should have at least 3 months of your expenditure somewhere in an emergency account, not assigned to anything else. I'm not talking about the new car fund or the holiday fund, something completely separate. Now, if you do have that potentially means that any policy like this wouldn't actually need to come into force for 3 months. This brings the premium down by having a deferred period on it. And this is where I said it can be quite clever for employed individuals as well. If you know you get 6 months full pay from your employer, setting up a policy with a 6-month deferred period may be an absolute bonus for you. It will bring the cost down hugely because the chances of you claiming are much less. If you're self-employed, it's a different story. You need to work out what your emergency account can do for you. And if you haven't got that behind you, it may well be worth considering whether you need to insure yourself for your own sick pay policy. Income protection can be set up on 2 different variables. They call them own definition or standard living tasks. And this is how they'll assess whether you qualify for sick pay. Obviously, a doctor's note or something equivalent has to go alongside it, but you can set these policies up so that if you can't do your specific job, then it will pay out. The fourth and final one that I want to talk about is family income benefit. Now, this is sort of a mishmash of the 3 that we've already spoken about, but is generally seen as an alternative to life cover and critical illness. Family income benefit really does what it says on the tin. It provides a benefit to your family should you be unable to fulfill it yourself. Now that could be if you are dying or if you're critically ill. It pays out a monthly tax-free lump sum to the family until the end of the policy date. Normally we would set that date to most likely being when the children are 21 or something along those lines, when they're dependent. There is of course a flaw with this, and that is that you will pay a policy amount that could potentially need to cover you for X amount per year until the policy term. But if you end up claiming 2 years before the policy ends, it may be that actually the policy is only going to pay out a couple of years worth of income and then be gone. You have to weigh up, as with all insurance policies, whether that's the right option. For some, they may feel that taking a life policy that will guarantee the same lump sum all the way through its lifetime is the better option, because whether you claim in month 1 or month 101, it will pay out a lump sum that will genuinely help. I would always say to you, think about the expenditure that you have and think about which ones of those would remain if you weren't here. A really good example of that, sort of tied into life cover or family income benefit, is things like private school fees. If you weren't here, but your children still were, would you still want them to have the same standard of life and same standard of education as if you weren't? In an instance like that, it might be that you set up a policy that runs until they're deemed to be independent that could cover all of their school fees. It could be there for that exact reason. The important bit about all these covers is that you identify the specific need and tailor your policy for it, rather than just taking them out generically. So, moving away from the policies themselves, how do they work? How easy are they to set up? Now, that really comes down to your background. But with all of these policies, they all have the same type of application. Now, these are normally interactive these days. They're normally done through computers, but you can still in the arduous paper forms that are 76 pages long. I prefer a computer. Some policies will have what's called non-medical underwriting limits. If you're taking out a policy that's under a certain amount, it may be that by doing it interactively, it goes straight through a computer and out the other end with a nice big tick. Your policy would then go on risk. That all depends on your age and the amount of cover that you're trying to receive. So it is worth just checking that against each provider. Each provider is different. However, that shouldn't put you off. A full application takes no more than 10-15 minutes now, and we can go through that with you. And all we say is honesty is the best policy. When you fill in these applications, they're going to ask a number of things. They're going to ask us personal questions such as height and weight, of course. They're going to ask about any long-standing health issues you've had. And they're also probably going to ask about your parents before the age of 65 as well. They're just trying to work out what the chances of you claiming are. But if you're not honest about it, then when you do come to claim, there could be difficulty. Ultimately, with all of these applications, there are three things that could happen. The positive one is that it could be accepted. If it's accepted, you can put a policy straight onto risk, and if something happened to you the next day, it's there, it's going to pay out. What could happen is that it's referred to a human being. Now this comes into the non-medical underwriting limits. If you've put something in there that needs to be reviewed, a human being will still check it in this day and age, and they'll come back to you and tell you whether they can cover you. That normally leads to two things. It either leads to you being covered but with a condition excluded, or being covered but the monthly payments are going to increase based on the level of risk involved. This is particularly relevant with BMI when we're measuring height and weight. The third one, of course, is that cover can be declined, and this is another reason why taking cover early is vitally important. There's no use, as with many of these things, trying to get the cover after the incident's happened. You wouldn't try and take out car insurance if the front of your car's already been crumpled. Now, it may be that you're listening to this thinking, I've already got a policy. I took it out with my first mortgage. I took it out when I had my first child. As with everything in financial advice, reviewing is key, and it's a big part of what we do. At least annually, you should be looking at your existing policies and making sure they still cover the need. A perfect example I can give you is that over the years, I've met many clients who have set up a policy on the birth of their first child to run for 18 years, and then had another one. That policy automatically is not going to cover for long enough. With that instance, it may be that an existing provider can change the terms, but if they can't, it may be that a new policy is required, whether it just be to top up or to completely replace. Likewise, critical illness conditions change over time. If you've got an old critical illness policy, it's worth comparing it to a new one and making that decision as to whether you may need to switch to a new provider to be covered for more things. Obviously, as you get older, premiums are going to rise, so it's that balance between affordability and level of cover. The bottom line is review everything that you've ever had, because it may be absolutely worthless if it hasn't adapted to your circumstances. And I can guarantee that a policy is not going to ask you whether you've had a change of circumstances.